deal with a lot of different questions on a daily basis, some from paid clients who are taking our training courses, others from random people on the internet that just want to learn. And I found that, I thought that I should say, because I don't know if this is going to be successful or not. This podcast could fail, right? We can get through episode 0 and completely blow up, but I don't think it will. But I look at the podcasting platform as a place for me to continue to share the type of knowledge that I get. And it's a lot easier to do so versus recording a YouTube video or writing another blog post, since people don't tend to read anymore. So that's my goal here, to help you become a better trader, as well as give you an inside look at my journey as a professional trader, right? I started tracking my journey ever since I was struggling. That's kind of how I got into the education side of things. And I believe that my journey is far from over. I will never be a perfect trader. I will try as hard as I can to be, but I'm always learning. I'm always making adjustments as far as trading goes, as far as other topics that we'll cover here, as far as the entrepreneurial side of things in general, real estate investing in general, just mental mindset, psychology, positivity, all of that stuff. I'm growing each and every day, and I'd like to share that with you guys. So the plan is for this podcast to be released twice a week. So each and every week on a Monday and a Thursday. And I'd like to keep the episodes to about 20 minutes max. I think about 10 to 20 minutes. I know you guys can get kind of long-winded if you haven't noticed already. I know you guys have a short attention span. So I think quick little nuggets is going to be the best way to have the message stick with you. Now, a little bit about my history. I told you guys that I started back in 2007. Really, I don't have any type of formal investment background. I think my story is pretty cool because it's not traditional, right? I didn't take the traditional route of going to college to learn about economics in the markets. I didn't do an internship on Wall Street or work for any big bank. I really kind of fell into trading by accident, right? I was in the unfortunate position where I graduated right at the start of what's now being called the Great Recession here in the US. So I graduated and essentially nobody was looking to hire me. So what I did was I had a free summer all to myself, which was amazing until you realize that, bills have to be paid and whatnot. But I spent my first summer out of college really shadowing a local millionaire. And I didn't know he was a local millionaire at the time, but he was a very, very close family friend to my girlfriend, now wife. And I heard he was successful. He was in the real estate investments. He was into the markets. He wanted to meet me mainly because he said I sounded like I had an interesting mind for business. Between me and you, I think that he was trying to vet me to make sure that I was okay to date his granddaughter. But either way, we ended up clicking. We shared a lot of similar thoughts. We had the same type of business mindset. And I decided that, hey, what better way to become successful myself than to follow someone that has already done it and just learn. So I spent the entire summer learning from this guy. I would go into the office in the morning. I would just sit there, right? Like a fly on the wall, sit there and just take notes and observe and listen to how he handled himself in meetings, listen to what he did with phone calls, listen to how he evaluated the markets, follow him around, just any type of thing I could, right? I would try to sponge information. And that eventually led me to get started in investments, mainly the stock market. And I had a pretty good run in the stock market. I still think in hindsight, it still bothers me. I don't know if I was actually skilled or if I just happened to buy at the right time, right? Everything was cheap around 2007, 2008. So maybe I just bought at the right time. But it worked out and I got pretty good at investments. And more importantly, I started to develop a passion for it. So yes, I was making some money, not anything significant enough to be life changing, but I was making money, which was good. But I started to love the game, right? I started to love the puzzle of establishing ideas, researching those ideas, trying to figure out when and where and why to buy, or when and where and how to sell. And then watching that game unfold. I am a big sports nerd, as you will find out shortly. And throughout these episodes, right, I talk a lot about sports. A lot of my analogies are sports related. So for me, it was kind of like game planning for your match, game planning for your game. And then instead of actually physically being there on the field or the pitch to play it out, you're just watching it unfold in the charts, which is really cool to me. And I still have that mindset of the market is a puzzle that will never be completely solved, yet it's encouraging and motivating enough that we come in each and every day and try to get closer and closer and closer to finding all those pieces. So I had a good start in the stock market, and I loved what I did. The problem was I wasn't making enough money to make it a career. I still had to work jobs in order to feed myself and in order to live. And that led me to trying different routes. I went from investing in stocks longer term to trying to do penny stocks, right? And I failed miserably. Everyone talked about penny stocks. You can get in, get out, get some passive income going on and have a good career off of that. I tried it and it was a completely different game. And eventually I had a friend of mine that introduced me to the Forex market. I had no idea what Forex was. He told me, hey, you can trade money. I'm like, that doesn't make any sense, right? So I use money to trade money. Like it sounds like a scam to me. Then he explained it to me. And of course, I went on to internet land and I researched it. And what do you think the first thing I saw was? Videos of dancing girls and private yachts and fancy cars telling me how in Forex, I can take a little bit of money and turn that little bit of money into a massive amount of money in a very short period of time. And I was like, yeah, I'm in. I want that. I'm good at investing, right? This Forex thing is easy. This is the path out. This is the path for me to go from rags to riches very quickly. So I jumped into the Forex market thinking I was great. And eventually I started trading with live money. The exact opposite. I didn't know anything about trading psychology at the time, but looking back, trading psychology is my main issue. That and the absence of a tried, true, tested trading plan. I was kind of just going in there off a feel and what do I think? What do I hope? What do I wish is going to happen? And I struggled in trading for quite a bit. And at the same time, I'll say this. One of the reasons there was never that urgency to get a lot better because again, I was working 3 jobs at the time. And again, being a kid that had recently come out of college, I was still in graduate school as well. I was working 3 jobs, making about $30,000 a year, which was a massive amount of money, more money than I've ever seen. Add to that I was living in an apartment, sharing it with, 4 roommates. I think 3 of them paid rent. 1 was just there. I was essentially living for free. So I didn't have a lot of bills or anything like that. So the money was good. And I don't know what changed it. Perhaps it was the busy schedule. My schedule was typically like this. I'd wake up in the morning, try to get some trading done. And then from about 7:30 to about 3 p.m., I would work in the school district. I worked with children that had mental and behavioral health issues, which, by the way, one of the most rewarding periods of my life. I was so educated on people with disabilities. I look at them completely different now. It also helped a lot with patience in the market. So it helped me as a trader, helped me massively as a person. Best period of my life by far. But I worked there from about 7:30 to 3. I then had about a half an hour commute to a local university where I worked as a track coach from about 3:30 to about, let's say, 6 o'clock each day, right? I was taking grad courses. So then I would go straight from track practice to a grad class, 6 to 9. And then, but wait, there's more, right? At night, I would moonlight as a janitor. So I would clean banks and I would clean preschools. And it was probably in the middle of cleaning a dirty toilet at a preschool, which, by the way, kids leave the most disgusting things in the most interesting places when you're dealing with daycares and preschools. But it was probably somewhere in the middle of me unclogging a toilet that was sitting there and simmering for hours and hours, waiting for me to approach it, that I realized this is not what I want to do for the rest of my life. I am burning myself to death. And I was young. I'm 21, 22 years old. So I had all the energy in the world to be working whatever 16-hour days. But I started thinking in the future, and I'm like, well, I do want to have a family one day. and I am going to get older and more tired. I do want to have free time to do stuff that I want to do. I don't necessarily want to be working this much, and I don't necessarily want to be pulling stuff out of toilets for the rest of my life. And that moment is when I made probably what was the stupidest yet best decision ever. I decided to quit all my jobs. I said, I'm done. Now, I planned it. It wasn't like the day after. I planned it how, I made sure I saved money and had enough to survive a certain period of time. But I decided to quit all my jobs and focus on trading 100%. Now, it's weird, and this is why I call it one of the dumbest decisions ever, because I wasn't good at trading. But I just told myself that, hey, Akil, when your back is against the wall, again, I'm a competitor and athlete. When my back is against the wall, you'll figure it out. You always have. You always will. You'll figure it out. So I quit my jobs and said, hey, we're going to make this trading thing work or you're going to fail at life. Long story short, I ended up working with a trading mentor, taking a professional trading course. Took me a while to admit that I needed help, but eventually I did. Throughout that trading course, I took it with the wrong mindset. So it wasn't like I just took the course and I became a super trader. No, I took the course and I still had plenty of setbacks. Setbacks that I regret at the time, but now that I am a teacher, now that I'm a coach, I value those setbacks because I now know exactly what you guys as struggling traders, I know exactly what you're going to go through. And it allows me to give you some pretty good advice on not only knowing what may be ahead of you, so you can plan for it before it happens, but also helping you get through it. But I did that. Eventually I became good at trading. I started managing money for others. And eventually I got into trading education and boom, here I am now starting a podcast for you guys to take in twice a week. So that's a little bit of background information about me. Of course, throughout the podcast, you're going to hear all of these stories in more detail. So the mystery of Akil Stokes will unravel. Some very, very good stories, some very, very devastating stories, some very funny as well. So it's going to be a pleasure getting to hear them. But I'm excited about this. Again, it gives me a different platform to talk to traders. I love talking to traders. I love helping traders. I really have a passion for the markets. I really have a passion for teaching. And this is just another way that I can reach more of you. So I hope you guys enjoy what is to come. You guys have been massive in supporting me throughout my career, from when I had a small little trading blog and I was journaling each and every day telling you how bad I am and how much money I lost in the market. You guys have been supportive since then, all the way up to the point where I am now, have over 2 million views on YouTube and was voted, fourth most helpful trader on Twitter and 19th best trading channel on YouTube. It's amazing. It's different. You don't see the same type of tribe that we have out there in a lot of other places. So I appreciate the support in advance. Something that you guys can do to help this podcast grow and hopefully become the best trading podcast out there is leave me a review. It's short and sweet. Head over to iTunes, rate me whatever amount of stars you can. Give me all of the stars. I want all of them. And then give me a review. Say, hey, I vouch for this guy. I like him. I don't like him. Whatever you feel. Don't lie. If you hate me, just write down, I hate you. The podcast stinks. But I think most of you guys appreciate what I do. And just, it takes a few seconds. It's a massive help if you can go over to iTunes, give me a rating and give me a nice little review. That way other people can see it. Other people can join, and we can continue growing our trading community bigger and bigger and bigger and spread more positivity and, of course, help more traders out there. So I look forward to seeing you guys in the next episode. Until then, plan your trade, trade your plan. Take care, traders. Hey traders, Akil Stokes here, and welcome to the Trading Coach Podcast. They say success takes time, but for some reason in trading, people seem to think the exact opposite. You see, we're stuck in this world where a lot of people require instant gratification, and when they don't get that instant gratification, they're very quick to quit. In today's episode, we're going to talk a little bit about that subject, maybe give you some hints on why we think this way and how to go about changing that thought process. Also going to show you how, by taking a little bit more time on the front end, can help you earn a massive amount of time on the back end. But before we get into that, do me a favor, head over to iTunes, give me a review, and I hope you guys enjoyed the show. Everybody always seems to be in such a rush. Why? Slow down some, relax. I don't know if it's me getting old, or maybe it's just times have changed, but I'm starting to feel like my grandfather growing up when he's like, these youngsters are going around and they just want everything right away, and success has got to be earned and you got to put in your work and all that stuff. But it's real. It's real. We live in a time where instant gratification it seems to be more than ever, meaning that people want that instant gratification, and if they don't get it right away, they quit and move on to the next thing. It's always shocked me in trading how the idea is, or I guess the expectation rather, is that you can become a very successful trader in a very short period of time. Now, don't get me wrong. I once thought the same exact thing. In fact, I don't think I would have gotten into the Forex market if that wasn't the case. I would have continued being a stock investor. So I can't fault anyone that thinks that way. But going through the journey that I have of kind of working my way up through really the whatever the bottom level you can think of trading knowledge. Again, I don't have any type of economic or formal background in the markets. The closest I have really is I took 2 economics classes in college and I barely passed both of them. And so I don't know if that counts, but that's the closest I've got to knowing anything about the markets, anything about the economy, economics. So when I first got introduced into trading, I was really at that very ground level of knowing what's going on. So I know in my journey, it's taken me years and years and years to, I don't even want to say master the craft, because I don't think we can ever master the markets, but to become consistently profitable. So I understand how long it really takes. And I have a brand new perspective on those who assume that they're going to be successful right away. And it's kind of disrespectful if you think about it. But what's always had me curious is this: why do we put trading on this particular type of platform where it's really closer to gambling versus closer to any other skill, right? Let's name any other type of job or that requires a skill. If you're a mechanic, right? Do you not have to learn? Do you not have to shadow? I don't know how long that type of operation takes, but I would assume it takes more than a week, more than a day, more than a month to become very skilled at it. We can take being an athlete. That's more up my alley, right? I know as an athlete, I started in sports at the age of 6. So I've been fine tuning, right? I've started fine tuning my skills, my athletic skills from the age of 6. And typically you don't go pro until at a minimum, right? In say baseball, or I guess soccer is a little bit younger, but you're still training. But you don't go pro until about the age of 18, maybe 18 to 21. So you're still looking at about 12, 13 years of training a skill. To even be more specific, right? If we go directly to our industry, right? The trading industry. Let's say you want to work on Wall Street. Well, can you just decide that, hey, I'm going to go get a job on Wall Street? No. You've got to go through your normal schooling as a kid, right? We won't even count that because that's required, right? Required schooling. You have to go up till grade 12. But after that, you got to go to college. That's going to take you 4 years to go through college. Typically, if you do want to get a job on Wall Street, you have a much greater chance if you have an MBA, right? So that's going to take you another, 2 years? Maybe you have to go through a year-long internship, right? Add another year on that. That's 7 years. 7 years of developing a skill, learning a skill, developing it, and then finally mastering it to the point where you can use it in your business for your career. Yet, so many traders, I see it every day, I get emails every day. I'm getting tired of responding to them. So many traders think that they can earn this type of success in a matter of weeks or months. Now, I will tell you this. I've worked with a lot of traders in my career, and the timeline for success is always different. There are those who are extremely dedicated, extremely sharp, and they can get it right away. There are others who never get it, to be honest with you. And of course, there's a whole bunch in the middle that take their time. But I would say typically this, I can teach you, right? When I teach traders, I tell them this, I can teach them the skill of trading probably in about 90 days, right? And that's teaching it in a way where you actually retain it. So not just teaching you the information and having it go through one ear and out the other in a crash course, but teaching you the information in a way in which you retain it. And that 90-day period is important because it has to do with breaking habits, right? Typically it's about maybe like 30 days to 30 to 60 days, 30 to 45 days to break an old habit. Another 30 to 45 days to install a new one. It's not really breaking, it's replacing, but that whole process is typically about, 60 to 90 days long. But after that period, that's just learning. And there's a big difference between learning and doing, right? Very similar to driving a car. I was taught how to drive a car in an empty parking lot. Easy, right? However, it was a lot different when I'm actually on the road with other cars and reckless drivers, and just the reality took a much different mindset than 6 o'clock in the morning in an empty parking lot. So for most traders, I say it typically takes maybe like a year or so afterwards. I know for me, it took about 2 years before I really started feeling comfortable with what I was doing. And I think one of the best examples I can give is actually my trading buddy right now. I coached a guy named Jason Greystone, and he came in. This is a different type of cat. So let's put that out there first and foremost. Everyone is not like him. He has this ability to be extremely focused. And when he puts his goal towards something or his mind towards something, it's kind of all in on completing that goal. Nothing else in life matters. He was able to become a successful trader in probably about a year. And this is one of the sharpest people I know, right? So to put that in perspective. But going back to what we started with, that instant gratification, it's really a double-edged sword. It can certainly be something positive, but I think it's the reason that we have these false expectations, or that we don't follow through on many of our actions. Right? And for you guys that aren't familiar, instant gratification is basically being rewarded right away. So we take a specific action. That action is expected to be met with some type of reward, right? I've got a 3-year-old kid right now, so it's the same thing with him, right? If he does a good job of eating his dinner, he can get dessert. And he expects that now, right? We probably shouldn't have trained him to that. Now we got to keep buying snacks and whatnot, but we trained him to that. He eats his dinner, especially his veggies, right? Veggies make him big and strong, like daddy, right? He eats his dinner, he gets his dessert. So he associates that right away, where it's like, hey, if I do this one deed, I get something pleasurable, right? And that's what instant gratification means, or that's what it does to us from a psychological standpoint, right? Humans, we act mainly mainly off of what's called a pleasure principle. And that pleasure principle, you can think of it as like it's like a driving force that compels us to gratify our needs, our desires, our wants, our urges, all of the things that we do. There's a fear element too, but for these purposes, we're going to talk about the pleasure principle, right? But everything we do, needs, wants, desires, urges, right? Breathing, eating, drinking, it's all because of this pleasure principle. And it could be basics like that. It could also be bigger things. It could be the latest toy, right? It could be the latest iPhone, the latest car. I know me growing up, I wasn't very motivated by things that I didn't want to do. But my parents did a good job of motivating me by basically bribery, right? I remember I was struggling in about 7th grade, right? After 8th grade is when you go to college. 7th grade is when they look at your grades, or 8th grade is when you go to high school, excuse me. I guess we did the same thing for college too, now that I think about it. But I remember them saying that if I got these certain grades, I would get a video game system. So I right away, I associated, hey, I'm going to do good on this test and I will be rewarded with a video game system. And it was it was a big picture reward, which I think helped me down the road, because most of the rewards that we are promised deal with instant gratification. Again, my kid, finish your dinner, right away you get dessert. In my example, I had to get good grades throughout a year. It was a year-long process. And then at the very end, I can reap the benefits of it. And that's the mindset that we have to have going into trading. It has to be a very long-term mindset. We have to understand that it is going to take a massive amount of time to become good at something. It's going to take hours and hours and days and weeks and weeks and months and potentially years to develop our skill, to learn and develop our skill to the point where we can actually reap the benefits of it. Now, most people don't have that patience. Akil, I'm not going to work for years and get zero reward. That's a waste of time. Well, is it? Think big picture. How many years do you have left on this earth? Me, I am what? I never remember my age. Gosh, what am I? 85, born in 85. That makes me 30, going to be 33 this year. Ooh, I'm getting old. I still feel like I'm 23, except I'm a lot more tired. So I'm 33. I'm going to be 33 years old. So I'm 32 years old right now, right? I plan on living. My body's pretty beat up. I plan on living. Actually, let's do this. Because I started trading back a long time ago. So I started trading back when I had to be about 23, right? 22, 23. And one of the main reasons that I got into trading was because I was looking at the future, and I wasn't happy at what I thought my future was going to be. You probably heard the story a million times, but I graduated college right at the beginning of our recession. I could not get a job, so I entered graduate school, thinking it would buy me a few more years for the recession to end and jobs to open up. That didn't happen, and I was in the weird place where I was overqualified because I had a master's degree, which means that the companies would have to pay me more, which is what they didn't want to do. But I was also underqualified because I never had a real job, so I didn't have any experience. So I was kind of the one whose resume just got thrown out. So in order to make things work, right, to make ends meet, I worked 3 jobs, right? I worked 3 different jobs. I worked a heck of a lot of hours a week, but it got the job done. I was making about $30,000 a year, which, again, for me, kid, right out of college, I'll take it. More money than I've ever seen. And for a while, I was pretty content with that, right? Again, I had that instant gratification. I work extremely hard, but then I get a nice big paycheck, so I'm being rewarded for it. But one day I started thinking about the future. And I think it was when things got a little bit more serious with my girlfriend at the time, wife now. And I started thinking, hey, we've been dating for a while. We're at that point where her family started putting the pressure on, uncles and stuff. Hey, so when you guys get married? Cause that's what we do here in this family. I'm like, geez. So eventually I started thinking, right after enough subtle and some unsubtle hints about our future. And I've always been a planner. So I think about, hey, I'm kind of old school. I know women take care of themselves these days. I know that, but me, the old school man I am, I still kind of figure myself as being like the leader of a family. I should be able to provide, if worse comes to worse, if something happens to my wife, I should be able to provide for my entire family. So I started thinking about that down the road. How can I provide for her, for us? How can I provide when we eventually have kids? And I started doing the math. I'm like, man, $30,000 while living in a 2-bedroom apartment with 4 roommates, or 3 roommates, including myself. Kind of 4. We had one that just kind of hung around. $30,000 doesn't go as far when you have a family, you're living by yourself, and you have to buy more than just ramen noodles and peanut butter and jelly sandwiches and water. And one of the things that I thought, I was trading at the time, I wasn't very good at it. I wasn't taking it too seriously, but I was interested in it, certainly. one of the things that went through my mind is, how much time do I have left on this earth? I actually did this very depressing kind of project where you basically you work backwards from your death. It's a good exercise, right? You write your own obituary, but it's kind of morbid. So I don't know, but I thought about how long do I have to live, and let's just say I live to 80. All right, let's just say I live to 80. At the time I'm 22. So that gives me 58 more years to survive on this earth. And it kind of just made sense. I said, you know what? If it takes me 2 years to learn how to trade, and I get good enough at this skill that I can provide a life for myself and my family for the rest of my time on earth, it's well worth having 2 years of kind of struggle for 56 years of pleasure. Is it not? Right? It's a no-brainer. But I don't think a lot of people think that way. I don't think a lot of people think big picture, and really bigger picture, right? The cool thing about trading is it's a skill that I can pass down from generation to generation. I'm not going to force my kid to become a trader, but I will definitely teach him the skill. Therefore, if he ever needs, worst case scenario, and the same things with my real estate business. Worst case scenario, my kid has a means to continue creating wealth even when I'm gone. And that can be passed generation to generation. So it's more than 56 years left. It's really an eternity. It is an eternity if you do it the right way. But the key is, are we focused on the big picture? Why are we so focused on the reward right away when we should be focused on the bigger picture reward that is much, much, much bigger and much, much, much more important? Think about that for a second. So the next time you get frustrated about not seeing profits right away, the next time you see a guru on the internet saying, hey, it's going to take you 2 years to get good, instead of just ignoring that, instead of just clicking out of that website and trying to find the first YouTube video that promises you great riches in a week, be realistic. What you're doing is no different than any other job out there. In fact, I'd say it's even more difficult. Because for most of you guys that are retail traders, you're doing it on your own. You don't have an instructor. You don't have a coach. You don't have coworkers. You're out there by yourself on an island, and that is extremely hard. But remember, what you're doing is the same as any other job. You are an entrepreneur as a trader. You are growing and building your business. Most businesses fail within the first year. A massive amount of businesses fail within the first 3 years. So just because you're not seeing the results that you want right away doesn't mean you're a failure. Success takes time. And if you go through the steps the right way, it may take a little bit longer now, but you're going to open up so many more years down the road. And isn't that what should be important? I think so. As always, I appreciate you guys joining me for this podcast episode. I love it. I love it. Still new. So I'm just going to get better. But I love the conversations that we're having. If you love them as well, do me a big favor. Let me know. Leave me a review on iTunes. Give me a rating. Subscribe, comment, share this with your buddies, whether they're entrepreneurs, whether they're traders, whether they're real estate investors. No matter what it is, whether it's just a person that wants some motivation, share it. Get the word out there. And let's build this podcast into, one of the best podcasts out there. If you continue to do that, I will continue to come back every week and provide you with greatness and excellence and a little bit of humor mixed in there as well. And until next time, remember, plan your trade, trade your plan. Take care. Hey traders, welcome back to the Trading Coach Podcast. I'm your host, Akil Stokes. It is a beautiful day, and I've got a pretty interesting topic that I want to discuss with you. Today, we're going to be talking about goal setting. Now, I've always been told that when you put your goals out there, you're more likely to achieve them. However, that might not actually be the case. It's all about how you put your goals out there. Are you putting your goals out there in order to hold yourself accountable? Or are you putting your goals out there just to get a tap on the back? We'll discuss. But first, I need you to head over to iTunes, leave me a review, share this podcast with your buddies, and help me grow this into the biggest trading podcast out there. So, as I was scrolling through the recent comments from a YouTube video that I did, I noticed a notification from a trader friend of mine that was doing videos himself. And I know he's been doing a lot on social media, sharing his results and kind of sharing his journey. And I decided to click the video. Now I have a lot of traders that I work with doing this. I wish I can say that I have watched every single one of all of them. But I haven't. But in this particular situation, I had the time. It was about a 5-minute video. So I clicked it, and it reminded me a lot of myself. And my whole trading journey started, as far as coaching goes, by writing a blog. It was something that my trading mentor recommended I do. Keep a diary, keep a journal on your trading. And at the time, I'm graduated college, sports guy, rah-rah, manly man. And, I didn't think a diary was, something cool to do. So I started a website. It was a website mainly based off of positivity with a few friends of mine who were going through some hard times. And it ended up being a place where I can share kind of my trading journey. And what it did for me, it gave me a chance to reflect on my day, reflect on my week, reflect on my trading, which ultimately helped me become a better trader. It was essentially I was doing an evaluation process without even knowing it. But over time, that blog became popular because, well, I was in the same place as many other traders. I was struggling consistently, and most traders out there are struggling as well. So it became a place where it was pretty cool to see something different than the, hey, I made $1 million today. Really see a reality of trading that wasn't on the internet before. And I always applaud traders that do that, especially this trader that did a YouTube video, because the internet is a harsh place. The internet is where you see the worst of people, right? You have keyboard warriors that sit behind their computer all day anonymously, and they have the ability to type whatever mean stuff they want to type about you. And especially as a trader who is struggling, someone that is honest and going on social media saying, hey guys, I made this mistake. Hey guys, I messed up here. It takes a lot of guts to just put yourself out there. And that got me thinking of the topic about goal setting. I work a lot on goal setting with my traders, with my track and field team that I coach. We work a lot on goal setting as well. And something that I've always heard in the past is put your goals out there, right? If you put your goals out there, you're 90% more likely to get them accomplished, right? You're 90% more likely to achieve them. That's kind of what's been said over years and years and years. However, I remember a TED Talk, probably back, it was a while ago, maybe back in 2010. I remember a TED Talk where a guy gave a presentation actually talking about why you should keep your goals to yourself. And it was an interesting concept because it's really the exact opposite of what you've always heard. And the thing was this. Obviously, there's going to be a lot of elements and a lot of moving pieces that get involved. But in general, his theme was that by just putting your goals out there, you receive what's called social satisfaction. Meaning, if I go on Facebook and say, hey, Facebook, I'm going to lose 20 pounds by January, right? That's putting my goal out there. However, it's not really putting it out there in a way that motivates me. And again, it's going to depend on the person and how motivated you are. Are you motivated to actually get it done, or are you just one of those people that likes attention and counts your likes on social media? But by just putting your goal out there, the typical response that you're going to get from any type of social media platform is, oh yeah, man, that's awesome. You got this. You can do it. That's a great goal. I'm going to do it too. All the rah, rah, give everyone a trophy type of response that we're used to. And what that does is it gives you that social satisfaction. So before you've actually made any work at achieving the goal, you've already kind of achieved the results, or at least your brain feels that way, right? You've already got the tap on the back. You've already got the hey, attaboy, right? And your brain is like, mission accomplished. It's very similar to if, again, I'm a big sports guy, very similar to if I were given a trophy, if I were given a medal for winning before I actually played the game. It may not seem like it. Now, for me, I'm a very harsh competitor. Everything I do is a competition, every single thing. So I'd probably still go out there with the same mentality. But the majority of people probably wouldn't try as hard, right? Think of it like this in another sense. What if you got your paycheck? What if you are a commission-based worker? You're a car salesman, right? So you get paid based off how many cars you sell. What if you got your paycheck before you sold any cars? Would you be any more motivated? It actually brings me to a funny story now that I think about it. I had got fired from a certain fitness center that I worked at back in my college days. They said I got fired because I wasn't wearing my uniform, which was false because the uniform was either khakis or athletic gear. And that's, as a college student, that's all I wore anyway. But I remember having a conversation with one of the older employees, and my job was I worked the front desk, so it was to greet people and check them in and really sell memberships. They wanted us to sell memberships, but there wasn't really a hard push for it. And I remember having a conversation because I didn't really try too hard to sell memberships. That's just not, for you guys that know me, I'm not a hard salesman. I'm not one of those guys that's, hey, in your face, buy my stuff. I'm kind of more under the philosophy of, hey, if it's good enough, you'll want to give me money for it, right? I do the same thing with my trading. I don't really actively market my trading education company, right? I'm not in your face saying, you need to buy this, you need to join this, you're going to fail if you don't do it. I'm more of like, hey, I'm just going to do a really, really good job. And if you are someone that is intent on getting better, you've already come in with the idea that, hey, I'm going to buy something. And the only thing that you're judging me on is my product worth it? Right? So I'm having a conversation with this older employee, and we get to the whole sales thing. And I'm like, hey, I'm not really motivated to sell. I'm not going to try to do a hard sale on anyone because I don't receive anything from it. He's like, what do you mean? I said, well, think about it like this. Right now I'm getting about $15 an hour sitting here, checking people in and washing machines and all the fun stuff that we do at fitness centers. If I sell 0 new memberships, I'm still getting my $15 per hour. If I sell 20 new memberships a day, I'm still getting my $15 per hour. I have no extra motivation to make any sales because it doesn't help me financially. Now, if you gave me a commission, if you said, hey, Akil, for every yearly membership that you sell, I'm going to give you an extra whatever amount of money, I would be more motivated. And he didn't understand this. And I ended up getting fired because I think he went back to his boss and told him my opinion. And I'm very stubborn, so I'm not going to change my opinion. I'm honest too. So that was the end of that. But it goes back to the whole goal setting thing, right? If you've already got the satisfaction that you need, that you desire, that you want it by simply making your goal or putting your goal out there, you're not really motivated to achieve it as much. So I'm not saying that you shouldn't make your goals public. I'm a big fan of that. I do it in my head as well, but I tell people what I'm going to do. And then I tell myself, here's my philosophy. I tell people what I'm going to do. I know most people don't believe it because in general, most people talk a big game and never back it up. So I kind of use that as motivation. I put something out there. I know that the naysayer is going to say, oh, he'll never do that. And I use that as kind of an internal motivation to get the job done. More of I'm going to prove you wrong. Same thing when I first started trading. Hey guys, I'm going to be a trader. Isn't that gambling? Isn't that blah, blah, blah? Don't 90% of traders fail? I remember even my dad, I stumbled across a message, an email that I don't think I was supposed to get, of my dad telling one of my other family members, oh yeah, he's just into this trading thing for now, but he'll move on to something else, in a month or so. And that just fired me up. I said, I'm going to prove you wrong, Dad. I'm going to make it as a trader. I'm going to buy you something real nice. And when you ask, how was I able to afford that? I'm going to tell you with the money I made from trading the financial markets. Boom. So that's kind of my motivation. So, but if you're going to make your goal public, right, phrase it in a way that doesn't give you the satisfaction. So really hold yourself accountable. Just don't hold yourself accountable by putting it out there, but give yourself some type of consequence, right? Hey, if I don't lose 20 pounds by March, I'm going to give everyone $10. Now you've kind of held yourself accountable. There's a consequence for if you don't achieve it. If I don't lose 20 pounds by March, I want you to come to my house and take all the bad food out of my fridge. I want you to come and punch me in the face. Maybe that's a little bit extreme, but again, there's a consequence to it, because people won't just stop by your post and say, oh, that's cute. Yeah, good job. Right? They're going to come back, a month later. Hey, how's it doing? Cause, I've been in the gym working on my sparring, and, if you don't drop those 20 pounds by March, boom, 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 pow, right? Do it in that way. And it's a good exercise to do. And I think by doing it on social media the way that this trader is doing, he's automatically holding himself accountable, because he's not asking for praise, right? And none of the videos, none of the posts that I saw is he asking for anyone to tap him on the back and tell him good job. He's putting it out there honestly, saying, hey, this is what I'm doing. This is why I'm struggling, but I'm going to keep doing this. And one day I'm going to become very, very, very successful. You just watch. And that reminds me exactly of myself. The only difference is I did it by written word instead of YouTube videos at first, because, I don't know, that's people still like to read back then when I first started doing it in 2008, whenever it was. So hold yourself accountable. It's I'm not going to get into the debate whether it's bad or good to make your goals public or keep them to yourself. I don't really fall on one side or the other. But if you're going to make them public with a purpose. Don't just say that, hey, I'm going to be a successful trader or successful, whatever it is, and be happy with the initial feedback, right? In this world we live in, everyone's quick to just, again, give you a trophy for absolutely nothing. You don't even have to earn it. You just have to say, I'm participating, and you get something, right? Put yourself in a position where you hold yourself accountable. Tell people what you're going to do, and tell people what the consequences are if you don't do it. And those people are going to motivate you. Those people are going to watch you and follow you and make sure you're on the right track. And that's the type of motivation that you need to ultimately achieve your goals. So I hope you guys enjoyed this episode of the Trading Coach Podcast. If you did, as always, please do me a favor. Leave me a review on iTunes. Leave me a nice rating. Subscribe, of course, wherever you're listening to this at. And I'll see you guys next episode. Until then, plan your trade your plan. Take care. Hey traders, my name is Akil Stokes. I'm a Forex trader and trading coach over at tier1trading.com, and welcome to the Trading Coach Podcast. In today's episode, we're going to do something a little bit different. I'm going to share with you some live recorded footage from one of my trading rooms and a discussion that we had on the pros and cons of trading just a single strategy. We're also going to talk a little bit about trading psychology and managing emotions and all of the fun stuff that you need in order to be a consistently profitable trader. Now, the recording gets a little bit long, so what we're going to do is we're going to break it up into 2 sections, but I think you guys will enjoy it. As always, if you do, let me know by leaving me a review on iTunes and sharing this on social media. All right. So if you're only trading a single strategy, and we've been working with the cipher for this example, right? If you're only trading a single strategy, because you don't have a lot of time to worry about other things, right? You have more opportunity to work on this. So you have more time to go back to the lab and test it and say, you know what, Akil, traditional targets are at the 3D2 and the 618. But if I start taking first targets at the 50% and second targets at the 786, that's actually more profitable. Right? So trading a single strategy gives you more time to work on the finer details of that strategy. And you can do this even if you're trading a million strategies. But again, if you have only one thing to concentrate on, right? If you have only one thing to concentrate on, you can start maximizing this. And then you can even, as Tony mentioned, you may pair like the Aussie Canada. And maybe that pair, it's more profitable to take both targets at the 382 and not even put a second target on, right? Now you can start getting detail for each specific pair in your portfolio in how you want to maximize those profits, right? Jason Greystone said this, I think it was in a podcast interview once. He said, your pairs are like your employees. Anybody a business owner here? Or anybody work in an office with lots of other employees, right? A good manager does what? Does a good manager treat everyone the same? No. A good manager knows his or her employees, and he knows how to motivate them. He knows that John over there may get motivated by tough talk, where you can go up to John and be like, hey, John, I need those TPS reports by 3 o'clock. Get them on the desk. And that may fire John up. John may be like, here, let's do it. On the other hand, you may have Malcolm, who if you treat him like that, he's going to crumble. If you give Malcolm a hard deadline, he's going to crumble. So you may have to talk to Malcolm and say, okay, Malcolm, here, look. So this is what we need by the day. You know, take your time, make sure you do it the right way. I'd love to have it by 3 p.m. If you can't reach that deadline, that's fine. But, you know, it'd be awesome if you can get it by then. All right. And then, of course, like you tell Malcolm that they're due an hour before they're actually due, just to give them that time so you don't get in trouble. But you treat all your employees different because we're all different as people. And your pairs are the same way. Your pairs are going to have personalities. Some pairs are going to be very trendy. Dollar Canada. Some pairs are going to consolidate a lot. Aussie Canada. You may notice the small differences in how targets are achieved. And if you can maximize that, you're becoming more efficient in your trading. Now, if you're trading, I always get the question of should you do that? If you're trading a million strategies, it's probably going to make your life more complicated to do that. Right? With the amount of strategies I trade and obviously the teaching that I do, there's no way that I'm going to have specific rules for each specific pair that I trade, for each specific technique that I trade. Because I know that I'm not going to be able to follow it. I don't have the time. With everything I'm doing, I don't have the time to remember that, dollar yen, supposed to take 50% retracement. But Aussie Canada, supposed to take 382. So I don't do it. I go for a universal approach, but that's because I trade a lot of strategies. But for someone who's locked into trading one thing and their full focus is on one thing, do you think it's too difficult to really customize how they trade that one thing per pair? Yes or no? Probably a little bit easier to manage, right? So these are some of the benefits of trading a single strategy. Can anyone think of any more benefits? Maybe from personal experience. The benefits from doing that is, you maximize each pair. You maximize each pair. So you're able to, I know you like the cow example, you're able to squeeze as much milk out of that cow as possible. Matthias says you build your RAS as well. Yeah. It's a lot easier to trade when you're looking for one single thing. You will get locked in on that. Now, of course, what do I always say about trading? There are pros and there are also what? cons. So for you guys thinking that there's one great way to do it and everything's going to be unicorns and rainbows and lollipops raining out of the sky, guess what? There's always a give and a take. What would be the negative of trading a single strategy only? I got you all pumped up. Now I'm going to knock you down back to reality. Hit you with the reality 2x4. Wow. So I see limited opportunities / less opportunities. So because you're only looking for one thing, that one thing is not going to occur as frequent. All right, for you guys that have started your back testing already, you know that opportunities probably occur a lot less often than you once believed. Many of you guys thought you were going to get hundreds of trades a year, and you realize that you've done 5 years of back testing and have gotten 60 trades total on a pair. I see missing out on other opportunities. True. Psychologically, you're gonna look at some big moves. You're gonna be like, man, can't involve myself in that. And you may start having psychological breakdowns where like you start seeing it over and over again and you want to involve yourself in it, but you know you can't. Fear of missing out, less dynamic. Quality over quantity. And yeah, and there's a way to, I mean, you can kind of hedge less opportunities by trading more pairs. The one thing that you're boring. Yeah. Well, I'll tell you what, if you get good at trading, it's going to be boring no matter what. So boring would actually be a positive. You know, when you're trading good, it's boring. Many of you don't know what I mean now. You will once you get good. You become so systematic. Yeah, trading is boring because you no longer get excited, right? The exciting part comes from like the gambling aspect. Or I should say the exciting part comes from the gambling aspect where you enter your first trade and you're like, I wonder if this is going to win or lose. And your heart's all thumping and you're sweating and you're like, oh yeah, we're moving in my direction. Oh no, we're moving against me. You know, it's like, you're playing roulette and that wheel is spinning. You're watching that ball bounce. You're like, oh, black, red, black, red, black, red, black, red, black, red. Right? That's the emotional aspect. When you become a systematic trader, it's, you no longer, let's put it this way, you no longer care about any given trade. I can care less. I'm sure Jason Grayson can tell you the same thing. That's why you see us so robotic in the live rooms. I can care less about a single trade because a single trade means absolutely nothing. Now, don't get me wrong, right? There, pride-wise, there are still some pride-wise, you still get a little bit of a good feeling. Like if you do a good CTS trade or a good trend continuation trade and you nail it, you're kind of like, yeah, I'm good. You get that feeling. But as far as like a monetary, like the result base, it just doesn't matter. Who cares? Right? With the amount of trades I take during a year, one trade really doesn't make a difference. I'm assuming I'm not doing anything stupid with money management. I'm not risking the farm on a single trade. But we also know it's process over outcome, right? My job is to, whether this trade loses or wins, my job is to take the next good trade no matter what. So I'm just here doing my job. And I know that if I consistently do my job, I'll make profit. So I already know the outcome. I say that in the most humble way possible. I already know the outcome of my trading year. I know that I'm going to be profitable this year. Maybe I shouldn't say I know because you never know what can happen, but I'm highly confident that I will make profit by the end of the year as long as I do what I'm supposed to do. And I'm very confident in my ability to do what I'm supposed to do. So I know the outcome. So it's kind of like we're playing the game where we already know the result. So therefore, it's not, you don't get as, it's, again, imagine yourself watching a sporting match on TV where the match happened yesterday, but you weren't around to see it. So you're watching it today and you already know what team won. But you're watching it and like there's still little like, interesting moments like, they scored, this team scored, but at the end, but deep inside, you know what team won. So it's not as exciting. Does that make sense? You already know the outcome. Now you're just watching the story unfold. That's how trading is for me. I already know I'm going to be profitable. And again, I mean that in the most humblest way possible. I don't know how it's going to happen because I haven't seen the game. Last year, again, I started off with a 17% drawdown last year. I got slapped in the face for 6 straight weeks. And then I won for like 10 straight months. The year before that, I started off really good. And then I lost like for 5 straight months in the summer. I didn't lose, but just went sideways. So you never know. You don't know how the story will unfold, but I do know what the end of the story says. The end of the story says I will be in profit. I don't know by how much, but I will be in profit. I'm very confident in that. In the most humblest way possible. I don't want the markets thinking that I'm outsmarting them. I don't want that bad mojo. So we're very unemotional about it. But one of the negatives, and I kind of lost track here. It's like you really feel it. Let's follow up on this a little bit actually, because I think that was surprising for a lot of you guys. I guess performance over time, but again, I should be an actor. How long did it take? It took me. I always say this. After you learn how to trade. So after you go through your process learning how to trade, you start working on your strategy and you kind of like dial down, exactly what you want to trade and you're ready to actually go after it with live money. I still say it takes about 2 years. It takes about 2 years to really find your groove after you learn how to trade. Because you may learn how to trade, but then you have to deal with the harsh reality of actually trading. And it's very similar to the difference between learning how to drive a car in the empty parking lot at 6 o'clock in the morning or riding on the streets early in the morning when no cars are out there and you're going kind of slow. It's the difference between learning how to drive a car, getting your license, and actually driving on the street with the crazies, right? Because there's a big difference. In that empty parking lot, it's all good. When you're out driving 6 o'clock in the morning and there's no one on the street, right, it's all easy. When you get on the highway and there's that crazy dude swerving in and out or the person that doesn't signal, it's a different story. But eventually you become comfortable with it. The markets are the same way. You may have done all the work necessary, but there's nothing like live trading. Live trading is an entirely different beast, mainly because of the emotional attachment that we have to money. This is why so many people, including myself, were demo account kings and live trading jokers. Because you don't want to underestimate the power of that emotional attachment to money. It is probably, in general, money, politics, religion, those are always the 3 hot topic buttons in life. Money is a very strong pull. For many of you, it's very easy to do everything you're supposed to do and follow your plan 100% while you're in demo mode. But what happens when that money's on the line? Does it feel the same way? Or do you start feeling these extra little pulls at you? Yeah, most of you it's a little bit different. I'm sitting in a dollar yen trade right now with my stop loss still in the negative. I'm up about 75 pips right now in this trade, and guess what I can still do? I can still lose money, and I'm only halfway to targets. How easy do you think it is for me to say, you know what, I'm just going to take my 75 pips. It's been a week. I did trail it. I am trailing it, Ivan. You saw the video. I am trailing it. How easy do you think it is for me to say, you know what, guys? 75 pips, right? You guys would consider that a pretty big win, right? How frustrating do you think it is for you guys to see the market come all the way down here and then start to put in a bullish day? And you start thinking, oh no, what if it comes back up? What if it comes back up? I could still lose 30 pips on here. Very easy to do that. And those are the small mistakes that will kill traders. So it takes about 2 years to kind of build confidence in yourself, build confidence in your system, and get in your groove. That first year is probably going to be filled with mistakes. Hopefully you evaluate yourself, and that second year you work on correcting those mistakes. And then as you correct those mistakes, you're going to start to notice that your bank account's going to get larger and larger. And then that's when you really start to gain confidence, where it's like, okay, I really kind of found myself. So I always say about 2 years. And obviously it's going to be, some people longer, some people shorter, depending on how good you are at correcting yourself. But usually about 2 years till you find your groove. And then once you find your groove, you kind of realize where you're at as a trader. And it gets kind of boring because you kind of, again, you know what your system produces. You know what your abilities are. It doesn't change too often. I mean, market conditions change, but it doesn't deviate too much. You're not going to have a 100% year one year and then have a 20% the other year. I hope not. You're probably going to be in the same range. And your job is simple. It's you go to work and do your job. It's no different from working at a company, right? If you're on salary, guess what? You know what your paycheck is every 2 weeks. It doesn't really change, does it? Maybe you get a bonus here, maybe you get a bonus there. Maybe the new tax plan gives you a little bit extra in your pocket. But you pretty much know what your salary is. You just go in and do your job. It's not as exciting as someone working hourly. I remember I used to work hourly, and I used to get those days or those weeks where I get like 10 hours of overtime. I'm like, can't wait to see the check. Ooh, can't wait to see the check. Then I got a job when I was on salary, and I was like, okay, yeah, every 2 weeks, just come on in. So it's not a bad thing. All right. But the negative side, going back to the subject, the original subject, the negative side, many of you guys mentioned this, of trading a single strategy, is the lack of diversification. And this is something that I personally experienced. I used to fall victim back when I was a pattern-only trader. I started off trading patterns only. When I say started off, of course, I mean after years of failing doing other stuff. But when I restarted finally, like the last time I started over and I didn't fail, I started off as a pattern-only trader. I never know how to word that, guys. Because I started a long time ago, but then each time I fail, I'm kind of like, I didn't really start. And then I fail again. I'm like, this doesn't really count as my start. This is the restart. I never know how to word that. So the most recent time I started, I guess, I was a pattern-only trader. And I consistently got hammered in the month of September. Now, who knows, if you've listened to all my interviews, right? You should know this, but who knows what typically happens in the month of September? The Stokes Army should know, right? Where's my Stokes Army tribe that follow every single thing I say? Let me hear your battle cry. All right. September is typically a trendy month. Now, it wasn't necessarily like this past year. But September is typically a trendy month. There's a saying in the market that says, sell in May and go away. And basically what that means is your big professional traders, right? Your Wall Streeters, right? They, in May, take a summer vacation, right? They go reap the benefits of all the hard work that they put in from January to May. And they go party in the Hamptons, and they get away from the market. They spend time with family, all the stuff that you should do, right? And that is what helps cause the summer slowdown, right? You guys have noticed in the summer, the volatility usually gets a little bit slower. Again, this past summer wasn't too bad, probably because of all the stuff we had going on in the world. But typically the summer just kind of slows down and gets kind of dull. I don't want to say it's not a very good time to trade. You can be very profitable. I had a very profitable summer this year. I know Jason Graceland did as well. We destroyed the summer. But it's different. It's just a little bit slower typically. And in September is when, as Tony says, those fat cats, right? They come back into the markets. And I compare it to this. I compare it to being a kid, right? You're a kid at home and your parents go on vacation for a few months, or let's say the weekend, right? And they leave you at home. They say, Akil, Gabrielle, the house is yours. All right? Don't mess anything up. And of course, You know what we do. You know. Partay. Right? So we party. We party a little bit, as we should. And, it's like Sunday night. Parents are coming home Monday, and we scramble to get everything back in place so no one knows. And we try to put everything back where we thought it was, but, we partied pretty hard. So maybe we forgot. So what happens is the parents come home and they notice that things aren't necessarily where they should be. And again, this is a comparison to the market, right? The market has ebbed and flowed in different places, and they come home and they're like, well, this shouldn't be here. Why is the euro dollar valued at this? I don't think it should be valued there. Yeah, Project X, yeah. I was just talking about that movie the other day. It's a horrible movie. Do not watch that with your kids. So they come back in September, right? They get back to business in September, and they start really pushing the market to where they think it should be valued at. So think about it like they start, whatever you messed up in the house, the parents come back and they start cleaning up and rearranging it to where it should be. And typically because of that, you see a lot of directional movement. Right? So if the market values the dollar yen down here at 105, right? You start seeing a big directional move to 105 because that's where the market, that's where the value price is at. And that causes a lot of trendy movement. You guys with me? Now, when the market, or I should say this, if you are a advanced pattern trader, are trending markets typically good or bad for you? Yeah. Trending markets are like a sheep. They're bad. Thank you, Tony. Tony's the only one. All right, maybe I won't be a comic. So yeah, so typically I used to get destroyed. Typically I used to get destroyed in September because the markets were incredibly trendy, and I was an advanced pattern only trader, and the markets would trend and really destroy me. Now that's not necessarily a bad thing because you still have the markets only trend about 30% of the time. They consolidate about 70% of the time. So, you're going to have plenty of months out there where patterns are killing it, but that particular month would consistently get me destroyed. So what I decided to do was I decided to start implementing a trend continuation strategy into my trading so I can also take advantage of those opportunities. Right? Does that make sense? So it introduced some type of diversification to my portfolio. Now I have advanced pattern formations which can take advantage of periods of consolidation. I've got a trend continuation strategy that can take advantage of periods of trendy markets. So there are some benefits of diversifying. Now, of course, it's foolish to think, don't think that means that you're going to catch every single trend continuation trade and every single advanced pattern trade, but it is going to even stuff out. So when the markets are trendy, right, my advanced pattern trading may be down. My trend continuation trading will be up. If I'm trading the right way and managing my risk reward, right, my wins are going to outweigh my losses. So I'm still going to be profitable. Vice versa, when the market's in consolidation, my trend continuation strategy is probably going to not do so well. But my advanced pattern formations will. So I'm kind of hedging myself in the market. And if you hedge, and the key of hedging yourself, not to get into a big thing about hedging, but it's all about risk reward. You make more than you lose, right? So it doesn't necessarily mean that you catch all trend continuation trades, you catch all counter trend trades, you have this awesome equity curve that moves from bottom left to top right away. But it means that there's a slow trickle in the right direction and you minimize your drawdowns. And that's the key, right? Instead of having a month like September where you catch a 10% drawdown because you just completely get destroyed, maybe you turn that 10% drawdown into a plus 2% return for the month. So it's not sexy, but you're moving in the right direction and you minimize those drawdowns. And when you can minimize those drawdowns, right, you give yourself a greater chance at reaching your next position sizing level, which allows you to trade more. And when you can trade more, you can make more. And when you can make more, you're probably more happy. So that's the negative side of trading one strategy. There's not that, you don't have that diversification. So your equity curve swings are probably going to be a little bit more violent. Your swings up, your extensions are going to be probably bigger, but your swing downs, right, your retracements are going to be bigger as well. So a lot of it depends on, hey, are you okay having a little bit more violent swings in the market or with your equity curve? Or do you want a kind of a slow, steady ebb and flow up? And there's no wrong or right answer to it, guys. You can't avoid it, and you shouldn't look to. I think that's the problem with a lot of traders. We're always looking to find this perfect way to trade. Guess what, guys? Do you think there's a perfect way to trade? You think there's a fix for everything? No. There's always a pro and a con to anything you do. You give me any strategy, anything you do, there's always a sacrifice to it. And I don't think you're going to become a good trader until you can accept that. It's really the same thing as life with time, right? If you want to spend time doing one thing, you are going to sacrifice time doing something else. And you have to be okay with that. You have to be, if you're not okay with that, you're always going to be chasing a ghost. And you're going to be that trader that bounces from system to system, trying to find that magic fix. And that magic fix does not exist. And that's one of the biggest differences between professional traders and amateur traders. Amateur traders blow accounts because they're never satisfied. They always want more. And they always think they can get more and more out of the market. Professional traders, I hate saying this because I don't believe in kind of just like acceptance. I always believe you should push forward and look for small improvements. And there are always ways to improve. But ways to improve aren't necessarily boosting your win percentage. Right? When I look to improve, I don't like to take my win percentage from 55% to 75%. I know that how I trade, I'm locked in at basically that area, 50 to 60%. How I like to improve is this: managing my trade, minimizing risk, maximizing reward. You can improve that way. My win percentage will be the same, if not a little bit lower. But if I can make more on average when I win and give back less on average when I lose, although my win percentage is the same or probably lower, I'm actually producing more profit. Follow me? This is why I can care less about win percentage. If you ever ask me, right, what do I tell you? Win percentage doesn't matter. My win percentage has gotten worse as I progress as a trader. I used to range in the 60s, 65s. I was in the 70s once when I was really bad. I used to range in the 60s, 65s. I am slow. I was down in the 55s. I'm slowly getting closer and closer to 50. 55, 50 is my range now. I wouldn't be surprised if one day I get down to 45. Jason Grayson always says this. He says, for me personally, right, he knows himself as a trader. He knows himself as a person. He says that his comfort zone, right, and not comfort zone in a negative way, but his comfort zone as a trader, meaning the level he needs to be at before he starts making psychological mistakes, is he needs to win more than he loses, right? Tell me if you've heard him say this before. He needs to win more than he loses, and he needs to make more when he wins than what he gives back when he loses. Right? So for someone like Jason Grayson, although this is more profitable, right? doesn't mess with his personality. Because he knows that losing more than 50% of the time, that's going to slowly eat at him, slowly develop little cracks in his armor. And if you guys have owned a house at all, right, you know how it goes, right? Those small cracks. What happens to those small cracks over time? Hate houses. Small cracks start getting bigger and bigger and bigger, and eventually they turn into gaping holes. And in trading, that gaping hole is Jason Greystone making a psychological mistake. Now, some may yell at him. They may say, Jason, you're an idiot. Do what makes more profit. Why are you giving up profit for your win percentage? You're still making more. But he's thinking big picture. Although he would make more changing his profit, right? He knows that the bigger risk, right? The long-term risk is that he sabotages his trading. He makes a psychological mistake. And we know that making a psychological mistake, well, you have the potential to blow everything. And Jason Greystone is saying, I'm not even going to put myself in that position. You follow me? I have the same theory. I'm a little more accepting of being 40% is probably my limit. But I've tested. I used to trade trend continuation strategies in the past that won 30% of the time and were massively profitable. They were more profitable than anything I've ever traded. But every time I would trade live, I could not psychologically deal with winning only 3 out of every 10 trades. Or rather, I should say I couldn't psychologically deal with losing 7 out of 10 trades. I could not deal with markets being up 100 pips and then going back down to stop me out for minus 200 pips. Every time I'd sabotage myself. Every single time. And this strategy was more profitable than anything I've ever traded. But I couldn't execute it live. I couldn't do it. Some of you out there can. Some of you out there are so disciplined. You're so hardcore on, hey, like Jason Stapleton was like this. Jason Stapleton, right? He was my trading mentor. Is my trading mentor still. Military. Discipline. Zero emotion. His philosophy was this. You trade what works the best. I don't care if it feels bad. You don't give in. And that's probably a little easier said than someone who was in the military, where they remove every bit of human emotion from you and you just do your job. So he's very disciplined because that's how he was taught. You just do your job. It doesn't matter if you like it or not. You do it. Not everyone's like that. I'm a former athlete, so I think I'm very disciplined. And obviously you don't want to make a comparison of athletes to the military, but I'm very used to being coached. I'm very used to needing to do whatever my coaches says, whether I want to or not. But there's still a limit. There's still a limit. And what matters as a trader is you find this limit. You have to know yourself. It's going to be different for every person. And it's not a negative or a positive. If one trader says, hey, I'd rather take less profit but be happier and not give myself a chance to self-sabotage, that's fine. If some trader says, hey, I want to take more profit and I don't mind having a much lower win percentage, that's fine as well. It doesn't matter. All that matters is you do what works for you, and you put yourself in a position where you have a positive expectancy. This isn't a comparison. We're not in a trading competition against others. We're just trying to survive. That's all we're trying to do, guys. We're just trying to survive each and every year. That's all it is. Self-preservation. That's all it is. So any other questions on this topic about trading a single strategy and whatnot? I think we covered a lot there. Whew. Feel good about that. Feel good. Is that good? You like that? Give me a yes. Hey traders, my name is Akil Stokes, professional Forex trader and head trading coach over at tier1trading.com. And welcome back to another episode of the Trading Coach Podcast. We started this podcast last week with really no expectations, and so far the response has been amazing. And because of that, we'll be back each and every Monday and Thursday with new episodes. In today's episode, we're going to talk about win percentage and why win percentage doesn't really matter. In fact, win percentage or chasing a high win percentage may be the downfall of your trading. But before we get into that, do me a favor, head over to iTunes, head over to Stitcher, leave me a review, leave me a rating. We are going to grow this into the best podcast in the world, and that's thanks to you guys. So I'm going to give this to you as straight as possible.
Welcome to the Trader Line Podcast. I'm your host, Richard Moglen, here with Ross Haber, and this episode is brought to you by Leadership Blueprints from Trader Line University. Leadership Blueprints is a comprehensive course which teaches the winning characteristics shared by past and present true market leaders such as Tesla, Amazon, and Apple. This course will train your eye to spot institutional accumulation and learn how to buy and manage high potential stocks. With 26 individual modules, 20 quizzes, and over 4.5 hours of video content, including a final webinar, this course is designed to sharpen your technical analysis skills and bring them up to the next level, no matter how you learn best. Check out the link in the description to learn more. And with that said, get your notebooks out and enjoy our interview with Stan Weinstein. Stan is the author of the well-known book, Secrets for Profiting in Bull and Bear Markets, where he coined the highly influential concept of stage analysis. He is currently the editor and publisher of Global Trend Alert, advising institutional investors. Stan, welcome to the show. Thanks so much for being here.
Hey, my pleasure.
Awesome. So to start things off, the process you enumerate in your book is almost entirely based on technicals. Many investors nowadays seem to ignore charts and focus only on financials or fundamentals. What would you say to these people to convince them to incorporate chart reading into their process?
Okay, first of all, when I was young, I used to proselytize. I wanted everybody to use technicals. I'm way past that. In fact, on a kidding around basis, I say now it's good. There are some people who will never use technicals, and we need that because if everybody used charts, who would we sell our losing stocks to? So the bottom line is that people that are open-minded and really are willing to learn that you need offense as well as defense to score in a football game. You need technicals at the minimum integrated with your fundamentals. And there's a reason why. I'll share this with you, Richard. Most people don't know, but I have a degree in economics. And many a year ago, it must have been probably 40 years ago, I used to do so many interviews. I remember some interviewer asking me, say, Stan, what did you have to do to become successful in the market? And he thought I was being facetious, but I said, put my economic degree on the side and learn to be totally technical.
Right. Yeah, combining fundamentals and technicals and listening to what the price action is actually saying, that seems to be the way to go, and just reading that supply and demand as best as we can.
Definitely, Rich. And let me give you a perfect example, timely-wise, what's going on right now. If you're just strictly a fundamentalist, and a few of my fundamental clients, override the technicals and they're paying for it. Gold is a perfect example. If you just take a look from a fundamental point of view, we all know the government is irresponsibly no longer talking billions but trillions, and they're spending money like crazy. And you'd say, oh my God, gold is a buy, and long term it probably will be. But right now, we put out a sell several weeks ago on gold, and it's been going down and paying no attention to what the fundamentalists would expect. So again, I always listen to the action of tape. I wrote that in my book many years ago. It's not the news, but how the market reacts to the news that's really important.
100%. And for listeners out there who have not yet read your book, first of all, I highly recommend it. There'll be a link down below in the description. But Stan, could you briefly discuss the kind of 4 different stages within a stock's life cycle, and also how you kind of differentiate between them?
Sure. I think that's a relevant thing. And it's so straightforward, and it sounds almost too easy to be really a success part of the equation, successful in the market. But here we go. Stage one, a stock. Let's use numbers just to illustrate what I'm talking about. A stock has had a big decline, Richard. It's fallen from, let's say, 25 down to 8 over many, many months. It's been bad. Now it starts to finally dig in and build a base. And just like a house needs a foundation, a stock, before turning around, people think, oh, if I catch the bottom, it'll maybe go up. That's just a short-term wiggle and jiggle. A stock needs to build a base, right, a foundation before it starts to advance. So we go into stage one. It starts to move sideways. But let's make believe now it's going between $8 and $10. And let's use a 200-day moving average. And let's say the 200-day moving average is still like at 14. Even though the base has started, you're still too premature. You want the 200-day MA to be close to the base. Now it's a couple of months later. It's still bouncing back and forth between 8 and 10, but the 200-day moving average, let's say it's at 10.5. Now you're ready to talk turkey. It's in the stage one base. Boom, it breaks out not only above the resistance at 10, but it also now goes above the 200-day moving average at 10.5. You've completed the base and gone into stage two, which is the advancing phase, and that's the ideal time to enter a stock. Interesting enough, when you're still in the base, the news will usually be bad, but it's no longer going down on the negative news. That's a positive indication. Now you're in stage two, and obviously stocks don't go straight up, but let's say over the next 6 to 9 months, the stock goes from 10 to 20, and you have corrections along the way, but all of the short-term corrections happen and hold above the rising 200-day moving average. Short-term wiggles and jiggles aside, you're still in stage two. It's great. Eventually, now let's say it's a year later, the stock has gone back up to 20. It starts to roll sideways between, let's say, 20 and 22. And the 200-day moving average is maybe 19.5. You moved into stage three. Interesting enough, Richard, at this point, the news will usually be good because there's a reason why the stock had this big move. Now people first pick up the Wall Street Journal and other newspapers and they'll say, oh, everything is terrific, and they'll buy it. That's a mistake. The stock is no longer going up on the good news. You're now the mirror image of stage one, where the news was bad, but you didn't go down. It was basing. Now the news is good. It's no longer going up. It's rolling sideways. You're in stage three. You start doing reducing. To make it simple, eventually you break below that floor of support at 20. You break below the 200-day moving average, which is close, let's say 19.5. You've gone into stage four. At that point, irrespective of what you think fundamentally, I'm a seller. I think now you've seen the high for the cycle. And if you look, well, obviously it's not perfect. There's always going to be one or two exceptions now and then. In general, when you study charts, you'll see this pattern repeats over and over again. And if people learn how to play it, I'm not going to be facetious, say it's easy, but the market becomes straightforward and much more profitable.
Absolutely. And in your book, you talk about the ideal buy point for both investors and also for traders. Could you talk about what those are and also what you're looking for in terms of volume, price action right at those levels?
You've obviously done your homework, Rich. You're doing a great job leading me. So here we go. Like we just said before, the stock, when it was in stage one, I have some of my institutions, and that's basically what it says, institutional product, although I do have some high-value net worth individuals also in here. But basically, institutions, because they're not buying an odd lot or two, they'll start doing early accumulation, knowing they're early. Well, it's still in the stage one base, but never when it's still in stage four. Then eventually, as you just alluded to, you break out, you go topside above the 10.5. It's going to stage two. That's the ideal time both for traders and investors to buy. But now we're going to become even more sophisticated. If a given stock breaks out into stage two, it's kind of like eggs. They're not all of the same quality. All breakouts are not of the same quality. So let's say chart A breaks out. Yeah, it's good. It moved into stage two, but the volume doesn't pick up. That's probably just going to be a so-so stock, and you don't want to do aggressive buying there. Conversely, we have stock B, which not only broke out above its resistance at 10.5, but in addition, the volume picked up significantly. And I like to see at least twice the normal volume of the past 30 days,
Right.
that's a good sign. And even better, in some cases, it'll be triple the volume. A stock that breaks out in heavy volume usually has a tiger in the tank, and those are the ones that, again, we're playing a probability game, never guaranteed. Those are the ones that'll usually end up being the big winners. And now I'm going to give you a subtlety, a third one, which I wrote in my book many years ago. If those two things happen, but we're still going to become even more finely tuned. One is in just a so-so group, and another, which we should talk about later in this interview, another is in a hot group. I'd always go with the one in the hot group. That puts all of your odds in your favor.
Perfectly put. And I was actually going to touch on that, on how you analyze group strength as well. So could you talk a little bit about your forest to the trees approach, how you go from market analysis, group analysis, all the way back to selecting the highest potential stocks that you want to buy on those breakouts?
Obviously, here we go. First, again, we're playing a probability game. Anybody who tells you, oh, I know the market is going to do this, or I know this stock is a definite winner, is a liar. Only the liars are always right. In fact, I wrote in my book, which most other people don't do. They only tell you about the good stuff. I put a chapter in the book where I spoke about losing positions, and I remember writing, even though it was like 40 years ago, I remember writing the words that how you handle a losing position will make you a winner in the market. Right. So it's very important that you blow out. If something doesn't work, I honestly think if we really do our good work, we can be right 75, 80% of the time, but only the liars are right 100%. And when you're wrong, hey, it's like you get another taxi coming along, you get out of that one, you pick up a good taxi. It's the same thing in the market. Now, to go to your question, the forest to the trees approach. One, it's, again, we're dealing in the ideal world. You want to have the market behind you. So you start with, are you in a good, healthy market? Which until a few months ago, it was terrific. Now I've downgraded it in the last 2-3 months from a rip-roaring bull market to now only moderately favorable. It's basically an even Steven market, which we should talk about in a moment. There's good and there's bad stuff here. But anyway, you want the market behind you. Then you go down to, what are the best groups? Like right now, for argument's sake, this is a very split tape, but there are some groups I like we've been having clients in the last several weeks buying stocks like in the building products area, coal stocks, aluminum. In the more conservative area, I've had them buy a lot of REITs, which have been great, a lot of utilities. And for more aggressive players, even though short-term they're extended, I like some of the crypto stocks, the cryptocurrency stocks. At the same time, there are a lot of bad groups we want to stay away from, even though they're rallying short-term. I don't like the airlines, cruise lines, restaurants, et cetera, et cetera. But anyway, so you want a good group. So you go from the market is in your favor to the groups that are the best. Then within those groups, Richard, you look for the best darn-looking stocks, best risk-reward characteristics within those groups. And hey, it's a filtering process. And if you do that, like I told you, you're never going to be 100% right. But first of all, this is an interesting thing that most people don't realize. I've seen over the years, clients who play the game right can be right less than 50% of the time. Focus on that. Less than 50% of the time. And you can make tremendous amount of money if you let your winners run and you quickly get rid of the losers. And I think we can do a heck of a lot better than that. I think that, as I said before, we should be able to bat at least 75%. And again, you got to be realistic. Most people don't realize, hey, you're playing a game of probabilities. Don't forget the last person to hit 400 many a year ago was Ted Williams. When he hit, I think it was 406. Hey, that still meant he made out 6 times out of 10.
Right. Perfect. And how should investors size their positions? Does it depend on the quality of the breakout? And kind of what are your thoughts on concentration versus diversification?
You're asking so many good questions. There's no one magic answer, Richard. I always, when I used to be on the seminar circuit, which I no longer do, I used to say you buy and sell to the sleeping level. Some people, will go very aggressively and they just want to hold a few positions. There are other people that take a look at, oh my God, you're turning your account into a mutual fund and they want to have 100. I don't think there's a magic answer. I would just say that for me, I think that it's a mistake even though some people swing for the fences, to just have 3 or 4 positions, because if you turn out to be wrong, even though you win, when you're right, you win big, you get hurt significantly. Conversely, you can over diversify. So I would say, something like 15 or 20 positions that are all good positions, maybe 4 or 5% for each position. And then if 1 or 2 don't go your way, you're not going to be blown out of the water, I think makes sense. I'm a little more conservative that way. But again, each person has to decide what their risk level is and how averse they are to risk.
Wonderfully put. And I think this is a really good question too. On the other side of the coin, once you're already in a position, say you bought a breakout right at 10 as it's moving into a stage 2 uptrend, how should traders and investors manage the position using your methods? And do you wait for a stock to break certain key moving averages and sell on weakness, or do you also kind of look to sell some into strength and sell proactively at all?
You're asking so many good questions, and there's really a lot of answers there depending on who you're talking to. But let's start out with the investor. For the investor, it's really easier. He should, or she, depending who they are, they should buy initially at least half the position when it breaks out. Then when you see it's not a false breakout, let's say you bought it when it went through 10.5, and hey, it only went to 11, then it fouls up and it breaks back into maybe 9.5. It's not working right. You're not going to buy any more, and I'd start reducing. Conversely, now let's be optimistic. It broke out through 10.5, it ran up to 13. Okay, you're very happy. Now it pulls back, and it really, the old ceiling of resistance, Richard, should now be the floor of support, roughly. So it now pulls back 10.5, 11, it holds where the breakout was. By the other half of the position, it's good, and especially the volume came in the breakout, and the volume should decline as it pulls back. You're now done. Boom, you're fine. Now the investor just basically rides it. But even an investor, because what I'm saying now is very different than when I wrote my book in the late 80s. We're dealing with the new norm. This market is no longer the markets I played in the 70s and 80s. This is, oh my God. I kid around with clients. A lot of times I say, you can't go to the bathroom and come out without being surprised here. This market is moving at warp speed. So even in an investor who bought the stock at 10.5, and let's say it becomes extended and it runs up to 16 in a hurry, and it's 50-60% above its 200-day moving average, I would then not be looking to sell. That's the wrong word, but the right word is trim or reduce. When something gets very extended, I would then say, let's take some off. I always kid around with my institutional clients, and I say profit taking is not a dirty word. You take a little off, and again, it depends on the individual market player. Some will take off 20%, some will take off 30, 40%. You take some off when it becomes extended. Watch for things like, remember, I'm talking as a trader now. The stock has run up, it's extended. Now it's starting to churn sideways. It's no longer advancing on good news. You take a little bit off, and hey, let's say you took 25% off. It pulls back ideally toward the 50-day moving average, which is a short-day moving average. It holds there. You start putting it back on. So that's how the investor plays. The trader plays a whole different game, and the trader has to be on top of it night and day. When he sees the stock is extended, boom, he should take off much more than the investor does. And then if down the road, Richard, at any point, I'm talking for traders now, at any point the stock breaks below its 50-day moving average, the trader should be 100% out, while the investor should be cutting back further.
Perfect.
So Stan, I'm going to zoom us out big picture real quick, and then back in a little tighter. I was just curious, if you do you take into account, and do you use, is there any way you analyze the health of the overall market or look at the, general indexes, or is that just not, you just look at your stocks for your information? And then I guess from there, I would, dialing in, really focusing in, other than your price volume, the charts that we discuss in your book, is there any other? And I know just from your newsletter, you've got your proprietary indicators. So that was basically it. Is there any sort of analysis you do on the general, market's overall health and do you have any, what other indicators are you looking at maybe that you could spit out for us?
Again, another couple of great questions, Russ. We could go on forever with this interview, but here we go.
Okay.
I'm trying to keep it basically simple. Like the old days of the seminar, sorry, I say keep it simple, not to stupid, but KAS, keep it simple, stupid. I'm trying to keep this simple here, but you're raising a lot of good questions, and this is what I deal with in my Global Trend Alert, which I put out a daily update, a weekend update, and then a quarterly in-depth 70 to 80 page report every quarter. So there's a lot of other things which I can't go through quickly in this interview today. But yes, there are other factors we should look at. Like for argument's sake, the market was super healthy a few months ago, where that's why there used to be an old cliche in the street, don't confuse and mix brains with a bull market. Anybody can make money when the market's hot, okay? Mm-hmm. Right now, we're really separating the boys from the men from the little boys and the girls from the very little girls. This is a very difficult market right now. So now, yes, you have to factor in the overall market, which I'll just give you an interesting thought. And these are kind of things I talk about in the Global Trend Alert. You have to take a look and say, hey, last Thursday, just a week ago from doing the interview today, the S&P hit another new all-time high. Hooray! It should have been great. We should be rocking and rolling. And I put out, now not a major sell, but that night, a short-term warning to do trimming rather than buying, because I use what I call positive and negative divergences, and the S&P made a new high a week ago Thursday, but none of the other market indexes confirmed that breakout. In addition, the next day on Friday, the next day on Tuesday, the next day on Wednesday, then so far today, there have been more declines than advances in the next three sessions. That's not good action. So that's one thing that short-term is warning us, this tape is not beneath the technical surface quite as strong as the S&P would have us believe. Another subtlety that I spoke about that night was that while the market made a new all-time high, if you're using the S&P, you should have, in my weekend updates, at least twice as many buy recommendations as sells. Mm-hmm. And I have no brief with this. I'm just a reporter. I report what I see. Yeah. Actually, in this past weekend's update that I sent out to institutional clients, that it was even Steven. I think we had 2 or 3 more buys than sells. That's not exactly quote unquote kosher. That's a market warning us how split it is and how it's narrowing down viciously here. So I'm not telling you, be a bear, but I'm telling you better be on top of your game here, because I already see roughly 50% of all stocks are already in their own private bear markets, even though the overall market isn't. And that's an important thing to understand. And then you go back, because we can study history and say, gee, are there any similar times that you've seen something like this? And here's where, I think that I can bring something to the table, because I've been playing this game for 55 plus years. I go back to 1973, and I remember we went through that period. And don't get me wrong, I'm not saying what's ahead of us is going to be as bad as what was 1973-74, which turned out to be a granddaddy bear market. But in 73, I remember vividly, the Dow made a new all-time high at that point in early January of 1973. But so many stocks had already narrowed down and started their own private bear market at that point. Okay. At the same time, the Nifty 50, the go-go stocks of that day, Avon, Polaroid, Xerox, they continued to move up into June of that year, while the rest of the market narrowed. I think a similar thing is happening here. They just changed the costumes that they're wearing. Right. Now it's Facebook and Amazon, and Google, while a lot of individual stocks have already entered their own private bear markets. The Nifty 50 of these days, which is, the go-go stocks of these days, they're still doing quite well. So I see a tremendous similarity, and if history is a guide, which I always feel that it is, I know how this movie ends, and while I'm not telling you it's going to be today, I know the last reel is not a good one.
Gotcha. So you're really focusing on the declining breadth that you're seeing in the market.
Exactly. That you just said the key word, Ross, but you and I used to work together when you had your fun. The truth is that we all know this. When breadth narrows down, that's not a good thing. And most people don't realize, hey, the S&P last week made a new all-time high. How come the advanced decline lines haven't made a new high since early June? Again, there's something that's not quite right. So we've seen this game over and over again, and maybe this time, quote unquote, it'll be different, but I don't bet on market firsts. I bet on probabilities. So I'm telling you, I don't like the short term right now probabilities, and eventually I think it's going to become a bigger problem. And here's a number that everybody should write down. Dow 34,600. It is, if we break below that level, right now you're still above it. If you break below that level, it isn't like, oh, you're going into a bear market, but you've seen that the corrections in the past several weeks have been 1 and 2 day affairs. If we break and close below that 34,600 level, I think you're going to get a much more meaningful correction that's going to be more than a day or two. So, that's something else that we should stay focused on.
Perfect. We'll be watching those charts carefully and watching for signs of distribution and see what happens. Stan, it's been an absolute pleasure to have you on. I know you've got very limited time, but we'd love to have you on once again in the future. And we'll have your email and contact info linked below for any institutions who want to get in touch and check out Global Trend Alert.
Right, Ross. Let me just say one. Let me just say one other thing.
Sure. Listen, Stan. We're not kicking you off the phone. We just wanted to, be respectful.
No problem. But anyway, here's something that I'm offering your listeners. Okay. First, know that unlike the old days when I did the professional tape reader, that was $799. It was nice, but obviously an interface for everybody. Well, anyway, to cut to the chase, when I retired the professional tape reader, which was way back 20 plus years ago in 2000, Global Trend Alert had taken over, and this is mostly for institutions, but it's a very expensive institutional product because you can, in addition to getting my daily updates, my weekend updates, my quarterly reports, you can also interface with me. We talk night and day. I talk with these clients. Anyway, to cut to the chase, that's a big number of any institutions out there, but a lot of people are soft dollar oriented, and it's $60,000 a year. But then when I retired the tape reader, I had some clients who felt bad, so they said, "Ooh, is there anything you could do for us?" And that's what I'm going to offer people today. I said, "Okay, fine. I don't talk with these people, but strictly on a reading basis, they can get the reading material, the daily updates, the same as the institutions get, the monthly, the weekend, as well as the quarterly, and that's only $2,500 a quarter, $10,000 a year. If somebody would like to see what the product is all about, but be serious. I'm being fair to them, so you'll be fair to me.
Absolutely.
If there's no way it fits in budget, then fine, don't do it.
Right.
But if you'd like to see a copy of what it's all about, Global Trend Alert, then here's an 800 number that they can call. 800-868-7857. That's 800-868-7857. And just give your email to my assistant. We can send out the input to you, and then you decide if it works for you. In the meantime, Ross, this has been great. I love working with you, and for now, everybody should be very, very cautious. This market is beyond difficult right now.
Perfect. Awesome. And Stan, listen, I just want to thank you so much for giving that offer, putting that out there. And I would say as one thing, I started off as a retail broker. I was an institutional broker there for a while. And I can't tell you how many guys with Harvard degrees and Harvard teams stuck to their fundamentals, ignored the technicals, and blew up billion-dollar funds. I would say one thing at that price, it's not whether you can afford to have Stan Weinstein on your team, it's whether you can afford not to, especially for those guys who are not incorporating the fundamentals. And I would say that from the bottom of my heart. So other than that, we're going to let you run. Good, happy trading today. And thanks a million again, Stan.
Hey, my pleasure. And just remember, as I used to say when I had the professional tape reader, the tape tells all.
Perfect. Stan, thanks again for answering our questions. And yeah, hope to have you on again in the future. And best of luck. Take care.
Hey, you have a good day, man. See you. Bye.
See you, Stan.
All right, for everybody watching, go ahead and leave a like down below if you enjoyed, and we hope to have a whole bunch more interviews just like this one in the near future. So stay tuned, leave a like down below, and subscribe to the channel if you haven't already, and we'll see you guys in future videos. Thanks. Welcome to the Traderline Podcast. I'm your host, Richard Moglen. Each of these episodes will feature a top trader or investor, such as market wizards and U.S. investing champions. Make sure to listen carefully as they share their stories and techniques that have allowed them to master their particular styles. This podcast is sponsored by Traderline University. Click the link in the description to learn more about exclusive experiences, such as the Swing Trading Masterclass, where you can learn directly from Oliver Kell, the U.S. investing champion. In his masterclass, Oliver explains his method comprehensively and walks through specific examples of his traits. Also, be sure to check out the Leadership Blueprints course, which will level up your technical analysis abilities and teach you proprietary edges and techniques you can use to identify and manage true market leaders. And with that said, sit back, relax, and enjoy. Hello everyone, welcome back to the Traderline Podcast. I'm your host, Richard Moglen, and joining me today is Larry Williams, renowned trader and veteran of over 60 years in the business, and also the winner of the World Cup Championship of Futures Trading with a return of over 11,000% back in 1987. Larry, it's a real pleasure to have you on. Welcome to the show.
Thank you. Pleasure's mine. I've been looking forward to this.
Perfect. And to start things off, I love hearing about how people got interested in the markets in the first place, how they got started in the business, and also early mistakes you made. So yeah, could you tell kind of people your story and yeah, how you developed your style to this day?
Well, early mistakes, I'm still making them. So I don't know where we start. It started for me in 1962. I was in college at the University of Oregon. I had my degree in journalism. I have no idea about economics. I took an economic class and walked out after one day. It made no sense to me. But there was a newspaper headline about the crash in 1962 because President Kennedy rolled back steel prices. And I asked him, well, what does this mean? Because I don't come from a family that ever owned stocks. My dad worked in an oil refinery as I did in summers. And they said, well, this stock went up 1 point today. That means if you would have bought it yesterday, you would have made $100. $100 in a day? Hello, this is for me. How do I get into this? It'll look like really easy work. Just guess what stock will go up. That should be pretty easy to do. Well, I found out it isn't. So it really compelled me to get into this with greed, nothing else than that. And it looked like easy money. And a challenge, a real detective challenge. And so that's what it began was a crash in 1962.
And along the way, when you're first getting started, what kind of resources did you turn to, books, other traders that you looked up to? How did you actually learn about the business?
Well, back then it was totally different than it is now. There was no internet.
Yeah.
The Wall Street Journal came about 3 days late, usually 4 days late after it was published in New York City, because I was living in Monterey, Carmel, California.